IBM has had its greatest day in 25 years, up almost 13% to $258 a share. If we look at the chart over the last year, you can see this massive jump was because of their more recent earnings that they released yesterday. This is the fourth quarter results for 2024. What we're going to be doing is looking at these values and then seeing why the market has reacted so favorably, and then taking it to my automated stock valuation spreadsheet to see if IBM is a buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So looking at the earnings, the CEO said we closed with double-digit revenue growth in the software for the quarter, further acceleration in Red Hat. Clients continually turn to IBM to transform with AI. Our generative AI book of business now stands at more than 5 billion inception to date, up nearly 2 billion quarter over quarter. People are liking that. So what we'll do is we'll scroll down here and we can have a look at these numbers. Where is it here? Here we have the full year 23 and 24 and then the quarter. So as said before, software is their largest part of the business. On the quarter, 7.1 billion to just shy of 8, and then that brings the full year from 25 to 27. Everything else is down ever so slightly, 5.2 to 5, which is a 200 million difference, 4.6 to 2 on infrastructure. That was consulting was the prior number, and financing down ever so slightly, and also other. But if we do look at the total revenue, 17.3 billion for the quarter, up to 17.5, and then total revenue up from 61.8 to 62.7. We look at the net income, which is down here, down ever so slightly, 3.2 to 2.9, and on the full year that is 7.5 to 6. And we also have free cash flow somewhere on this sheet. They did calculate it for me. That's the full year highlights, 12.7 billion, and also we have all the other numbers here. Revenue 63, net cash from operating activities 13.4. So what we'll do is we'll go to my automated stock valuation spreadsheet, put in the ticker, and this will load up the company financial data. We will not have the most recent numbers because, I want to release this video soon so you guys can have a look. But what we can do is we can manually override the latest numbers to get it in. So if I put in, I've opened up the revenue on the other screen, but if I put in the total revenue of 17,553 for the quarter, that brings it up to 64. I will also then do the net income, which was 2.915 billion. That brings us to 7.5. And then we did have free cash flow for the quarter. Where is the quarterly free cash flow? Scrolling. Free cash flow. They did estimate it at about IBM free cash flow was, okay, we'll do that. 6.1 billion, which brings it to 13. So they're expecting slightly higher, 12.7. But anyway, these are estimates that haven't been fully done, and I think the data is slightly different. But looking at revenue, this is going back to 2009, but if we look at the most recent years, they have steadily increased revenue since 2019, since the big drop, 64.36 billion. So this is increasing, which is what we want to see. Net income, once again, going back to 2009, but in the more recent years, trailing 12 months, just shy of 7.5 billion, which is increasing overall. Free cash flow, pretty good. They've always had a good free cash flow generation, and now it's at 13.2. Operating cash flow versus CapEx, you can see operating cash flow. I suppose it's on the trailing 12 months. I haven't added it in, but you can see that the operating cash flow has historically increased, and obviously the CapEx is low, so the operating cash flow will be higher. One thing I didn't run through at the start of this because I was too busy talking about it. We do have a 240 billion market cap, P ratio of 37, which is higher than the market average. Earnings per share, $6.90, beta 0.74. Analysts do have a target price at 240, so it's ahead of that currently. Dividend yield though, 2.92%, meaning you'll get paid $7.54 a share. Is it a safe dividend? Relatively, in terms of the free cash flow payout ratio, it is 53%, but the net income is a little higher with 93. Buy before the 10th of February if you want to get paid your quarterly dividend. So let's just go back to the, where were we? Operating cash flow. obviously free cash flow is up ever so slightly. Shares outstanding, they were buying back shares, but you can see there has been a slight issuance of shares. They have been increasing. And if we look historically at the price, over the last 5 years, it has steadily increased. So at the most recent point, we probably want to be, yeah, they were thinking they're undervalued at the minute. Where were we here? Let's go back to the discount free cash flow model. So this is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. Currently given it a price of $530 a share, very, very high. Let's see if we agree with the numbers. So in the next year, we have 66.3 and 68 billion, which is about 3% growth. Analysts are thinking that the growth is 65 and 68. So we'll decrease it ever so slightly. We'll do 2.5%. That brings us down to $500 a share. Net income margins, I think if anything, the net income margin should be higher. We'll do about 10%. And then finally, here we go. This is why, because of 2023. So what we'll do is we'll take an average of these 4 years, 186. We'll bring it down more. We'll go 174%. And there you go, $285 a share. So a lot closer, but discounted free cash flow does like the stock. If you're interested in my sheet, check my Patreon. Links are in the description. It's the $4 tier that can give you access to the sheet and all of the data. But enough about my selling or shilling my goods. What we'll do is we'll go back into this. Dividend discount model. Let's have a look at this. They have very consistent small growth recently of about 0.61. And the discount rate is that. So yeah, dividend discount model says it's quite overvalued, but with this small dividend increases. If they were to increase at about 4% or 3.5% a year, maybe a bit higher, just shy of 4, it would be fairly valued, but they do very small dividend increases, but still do pay a nice dividend. Ben Graham formula for intrinsic value. I don't think you'll like the stock. He hates all stocks at the minute because of the high bond yield. But if we have a look at the growth, yeah, 5% growth over the next year. Oh, 54% would be very good, but 5, only $78 a share. So finally, let's have a look at the comparable company model. This is a way of valuing stocks, looking at their comparable companies, similar industries, similar sizes. And we have a few that I want to compare. And we'll do a few different sets. What we'll do is we will look at HPE, which is Hewlett Packard Enterprise. This is IT, hardware, cloud solutions. We'll look at CRM, which is cloud-based enterprise solutions and AI. And we'll do Oracle as well. And then what we'll do is we'll look at Amazon, Google, and Microsoft as well, just to see. So enterprise value, sorry. IBM is smaller than the other two, but bigger than HP. Revenue growth, yes, it is down, but if we did that 4 years, it would be up. And just because of the 5 years in 2020 was a lot higher. EBITDA second highest net income. Middle of the pack profit margins. Price to sales, market average I think is around about 3.1, so slightly higher, but apart from HP, it is lower than the average. Price to book, market average is 5. You can see it's in the middle of the pack again. Peg Peter Lynch's price to earnings growth. Ideally want this under 1, and you can see IBM is the highest. But EV to revenue, EV to EBITDA, PE, and forward PE. Apart from HPE, if we're comparing it to Salesforce and Oracle, in fact, let me just change this around. We'll put Oracle here, and we'll put HPE here, just because I want to compare just the two of them. HPE is a lot lower than all of these, so that's why it's bringing the value down. But we can probably see here that it is still a buy comparing against these, about $308 a share. Only the forward PE is the least liked. But if I was to go to here and compare against just Oracle and Salesforce, you can see it's 360. So definitely undervalued compared to its competitors. Now, the other one I wanted to check was Microsoft, MSFT. Amazon is AMZN. And Goog, we'll do Goog. And let's compare these. So obviously a lot smaller than these companies, probably 10 times as small. And I just want to see what it does here. So interesting enough again. Yep, smallest enterprise value, smallest revenue, smallest everything. Profit margins, a lot lower as well. Look at Microsoft profit margins, 36%. But if we look at the value, puts it $320 a share, $390. So overall, dividend discount model, doesn't really like it. Ben Graham hates it. Discounted free cash flow model puts it undervalued, and the comparable company model, even with this massive increase, it does look undervalued to its competitors. So that's quite interesting to see. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Check out my Patreon, links are in the description, and I'll catch you guys next time.